I feel as though the financial world has lost the plot, and I feel that investors, especially after because of the tech and telecom bust, and then even more so after 08-09, have become extremely risk averse, and so much so that they are investing in the past. So what we're seeing is investors and analysts worrying about whether they will beat their benchmarks. Now, benchmarks are there because these companies have been very successful over time and they rise to the top of benchmarks. One of the reasons I started ARK is because we have never been on the threshold of as much disruptive innovation as we are today. And yet this shift into benchmarks is more about, as I said, investing in the past. So ARK is all about the new creation. I feel that we have witnessed in the last 20 years the most massive misallocation of capital in history as funds have really evolved towards these benchmarks. And it is during a period of risk off that we saw during 21 for innovation and 22, fear of interest rates rising in 21, and then the reality of interest rates rising in 22 absolutely destroyed assets of long duration. And I don't mean just stocks. Long duration includes long-term bonds as well. So last year, we had the worst bond market in really history since the 1700s because the Fed jacked up interest rates 22-fold in roughly a year's time. This has never happened in history. And I think it has been very destructive in that it has pushed investors even closer to their benchmarks. So they are buying Apple and the FANGs and the Magnificent Seven, and they are selling the stocks of companies that are innovating and creating the new world. Now, I say to my team, and Dan White, Associate Portfolio Manager on my team, I always say truth will win out. And the forces that this 22-fold increase in interest rates have set up, I think are going to move in the opposite direction and are going to reward long duration assets like long bonds, but also like innovation-based strategies, pure play innovation. These 5 platforms, so these are 5 innovation platforms evolving at the same time. This has never happened in history. The closest we've gotten to this is the early 1900s, when 3 innovation platforms evolved at the same time. Back then, it was telephone, electricity, and the internal combustion engine. Completely transformed the world. Today, we're talking about these 5, and the biggest catalyst in terms of all of these innovations is artificial intelligence. You can see it at the center here. So the 5 major platforms are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. We have, in the last 20 years, we were fighting in the financial markets. Now, I know a lot of you are in the venture world, you're entrepreneurs, and you may not relate to this, but what we are fighting in the public equity markets is notion, and have been fighting, that exponential growth, rapid growth cannot be sustained. And that is because we've been in a linear growth world for so long, where you do have a burst of activity, and then it decays down to the GDP growth rate. In the tech and telecom bubble, we first heard the expression exponential growth. growth sustained, say 20 to 30% growth sustained for years. And many people thought that was going to happen. And that's how we got the tech and telecom bubble. We had too much capital chasing too few opportunities too soon, and it ended badly. Now, the seeds for these 5 major innovation platforms were planted during the 20 years that ended in the tech and telecom bubble. And they have been germinating ever since. They weren't ready because the technologies were not ready during the tech and telecom bubble. We didn't get the cloud until 2006. We didn't get deep learning out of ImageNet until 2012. We didn't get the other big breakthrough in artificial intelligence, transformer architecture, until 2017-18. We were not ready for prime time back then. And even if the technologies were getting ready, they were far too expensive. So the first whole human genome was sequenced, or shall I say most of it, we thought it was the whole human genome, in 2003. It took $2.7 billion just to sequence one person's genome, $2.7 billion, and it took 13 years of computing power back then. Again, the technologies really weren't ready, and if they were even close to ready, they were far too expensive. Today, DNA sequencing, remember I just said it took $2.7 billion 20 years ago to sequence one person's genome. Today, it takes less than $500 and just a few hours of computing power. So again, that's a really good example of back then, too much capital, chasing too few opportunities too soon, right? Investors were chasing the dream. Today, where are we? As I just mentioned, the tech and telecom bust, and then again 08-09, has scared investors to death. And so here these technologies, again, the seeds were planted back then, they are ready for prime time now, and investors are running away. They're running for the hills. What are the hills? They're benchmarks. You know, it does take a lot of fortitude. As George said, I'm probably at my best in front of CNBC, who you all hate. But they do not understand that ARK is the closest you'll find to a venture capital fund in the public equity markets. And they truly do believe that rapid growth leads to inflation. And if you look at the history of the last 40 years, that has been absolutely untrue. You can see the numbers. They're just not looking. They're very Phillips curve, very Keynesian in their assumptions, and they're just wrong. So here are the 5 platforms, and I'm going to go quickly through this presentation, understanding it's after dinner, and this may not be as entertaining as most after-dinner speakers are. But anyway, convergence. So this idea of exponential growth, finally, it did get some respect. We do have a poster child, actually from this city, Amazon. Boy, were we fighting battles back in the early 2000s as we were going through the tech and telecom bust and then coming out of it. Nobody believed that Amazon could grow revenues at a compound annual rate of 25% per year on average for 20 years. And we were fighting that battle and fighting that battle and fighting that battle, and it finally paid off. But boy, back then, even when indexes weren't as powerful in terms of an attraction for investors, it was really hard to convince investors that we would see such exponential growth. Well, we did, and some people now do believe it's possible. What we are saying now is that we are going into a super-exponential growth world, because those 5 major innovation platforms around which we have centered our research and investing, they are converging. And so what we have are the equivalent, so all of you in the innovation world understand what an S-curve is. You know, start out slowly and then you get into the sweet spot. Well, what we have now are S-curves feeding S-curves. They're feeding each other, and we think creating explosive growth opportunities. And you can see that from the purple here, that AI, which touches almost every other technology on this sphere, that it is the major catalyst. We're putting a paper out, I think it will be later this month or early December, on this concept of convergence. And Brett Winton, who's our chief futurist, has actually analyzed which of the technologies are the biggest catalysts for other technologies. It's a scoring system, which I definitely will not bore you with tonight. But you can see at the bottom there, it is, and you can also see from the depiction here, it is the most important of these technologies in terms of catalyzing other technologies. Which are the biggest beneficiaries of these technologies, these 14 technologies, of this idea of convergence? We think it's autonomous taxi platforms. So autonomous taxi platforms involve the convergence among three of the major innovation platforms: robotics, autonomous vehicles are robots. Energy storage, they will be electric as the learning curve associated with drivetrain technology plays out, and electric vehicles become much less expensive than gas-powered vehicles, and artificial intelligence. So three: robotics, energy storage, and artificial intelligence. So let's talk about learning curves to get a sense of the drama here. I'll give you a few. Of the 5 major innovation platforms, there are some stunning learning curves evolving here. If you look at industrial robots, the learning curve, so as George mentioned, Wright's law, which is, we've centered our research on Wright's law, and the biggest surprise to me in the investment world, period, not just in the public world, but in the private world, is that others are not doing this kind of analysis. Most people in the public investment world do not know what Wright's law is. Wright's law is a relative of Moore's law. Moore's law is a function of time. Wright's law is a function of units. Now that the semiconductor world has slowed down in its cadence, it's kind of hitting a wall, Wright's law is getting the semiconductor forecasts right, or is doing a better job at forecasting what's going on in the semiconductor world than Moore's law is. Wright's law says for every cumulative doubling in the number of units produced, costs decline, costs associated with each technology decline at a consistent percentage rate. So in the world of industrial robots, again, we've centered our research, we're doing this research, we give it away because we think there are such inefficiencies in the investment world around innovation, definitely in the public marketplace. So what's the learning curve of industrial robots? 50%. Now, this is why technology is extremely deflationary. We hear all this talk about inflation going on, and I just wrote a tweet, just put up the Bloomberg Commodity Price Index from 1980 to today. It hasn't gone anywhere. We're at the same place, and everybody's talking about it. So I actually think, for those of you who have studied economic history, that we're probably closer to a Kondratiev wave on the downside than most people understand right now. And helping it along are going to be all of these technologies. So that 50% decline in industrial robots. For drivetrain battery pack system technology, that number is 28%. That's why Tesla can cut its prices and still be profitable. And I think the auto companies are baffled because they're saying, well, we can't produce these electric vehicles profitably, so we're not going to do that because their shareholders don't want them to do it. I don't know what's going to happen to them. All I know is this gives Tesla more room to run because the competitors are starting to back away. In the multi-omic sequencing space, or DNA sequencing specifically, that learning curve is 40%. Again, a 40% drop in costs for every cumulative doubling in the number of whole human genomes sequenced. And we're at a very low base, so we're going to see many cumulative doublings. And we're already down to $200 to $400 in DNA sequencing costs. In the case of artificial intelligence, the data metric here to compute Wright's law is it's a relative compute unit, and it involves a metric involving data per compute unit. For every cumulative doubling in that metric, costs decline by 48%. Now, the showstopper here, or the aha moment for us, was, okay, we did that, but AI training costs, when you combine both hardware and software, are dropping 70% per year. So what does that mean? The cumulative doubling is taking place in less than a year's time. That's why what's going on today is so provocative. All right. Here are just some examples. We know that we didn't know it actually, but it did take transformer architecture for Tesla to begin to believe truly that it was going to be able to complete the last mile in autonomous driving. So these are just a few of the convergences. This is DNA sequencing 60% more accurate because of the convergence between DNA sequencing and artificial intelligence. Again, this is in our big ideas. You can look up the details. Yes, this is robots and the convergence of robots and artificial intelligence, and just how much better they perform, whether they've done tasks before, but especially if they have not done tasks before, given this convergence. Battery advances, so just 3 times the battery capacity. This is since the iPhone, 3 times the energy density. And now we're talking about Meta platforms, Ray-Ban smart glasses. So our analyst and also assistant portfolio manager, Nick Gruce, bought some of these glasses, went golfing, I think with Dan, if I'm not mistaken, and had these glasses on all day. They didn't run out of battery power. Now, they did need a 10-minute recharge every once in a while, but he was taking pictures of them playing golf all day, and it didn't run out. Could not have happened without the advances in, oops, sorry about this. Yes, reusable robots. Here we just give the example. If you remember in the tech and telecom bubble, Iridium was one of the poster children of that age. And you can see how much a phone cost and how much more expensive it was per minute compared to terrestrial phones and minutes. And it was uneconomic at that time, and of course went bankrupt. Today, the combination of T-Mobile and SpaceX has collapsed that altogether. So pretty exciting there. Cryptocurrency, so what kind of convergence there? We worked with Square, or Block, a couple of years ago on a report which showed that if you incorporate Bitcoin mining into a utility ecosystem, so think about this. This is convergence of battery technology and Bitcoin in this case. what you can do is overbuild solar and wind, because what are we dealing with in that utility ecosystem? Huge battery storage systems that, in the case of Florida, they fill up. The sunshine is wonderful in Florida. They fill up, and then the energy would be wasted beyond that. Instead now, that energy is being allocated to Bitcoin mining and earning utilities more money so that they can overbuild solar and wind. So another convergence that wasn't obvious until we faced the environmental question of Bitcoin and all the electricity that it was using. Now there is a sustainable element to this ecosystem. GDP growth. As you can see from this chart, through history, technology has caused leaps in GDP growth. And you can see from, I think it was 1400 to 1900, or 1500 to 1900, the world was growing about 0.6, this is real GDP growth, 0.6% per year. And then those three platforms I mentioned earlier, telephone, electricity, internal combustion engine, of course, transistor, computers, internet, then that catapulted us into a 3% GDP growth world. The consensus view going forward is that GDP is going to downshift. We completely disagree. And we believe that we should see a greater growth increment than we saw in the period, in the last period. So that was fivefold, which would take us to 15%, but we didn't want to seem completely crazy. So we put 8% out there. But, you know, it doesn't make any sense that GDP growth should slow down given all of the innovation that is evolving right now. And the other thing that makes no sense is that inflation will remain a problem. There are two camps right now on inflation. One, and many of you, Stanley Druckenmiller has been interviewed a few times, so you've probably heard him on Bloomberg or CNBC, beloved CNBC. And he's very much in the higher for longer inflation. We're in the 70s. This is intractable. Look at the wage negotiations, the UAW, the auto companies, the airlines, 10% per year, 6% per year. And our answer to that is many of these industries are going to be disrupted, disintermediated, and perhaps destroyed. And so what will happen is that those wage gains will end up crushing margins. This is not going to be pushed through into inflation. If anything, we believe that we're going to enter a period of deflation. Now, I know deflation sounds scary. It sounds scary because of 08, 09. Everyone was talking about a deflationary bust back then, and it was horrifying, and you know, it was terrifying in many ways, because there was almost a complete financial meltdown. That's not what we're talking about right now. There's good deflation and there's bad deflation. I just gave you an example of what bad deflation will be. Companies that have not invested aggressively enough to move into the new age, and they're going to be disrupted, creative destruction. The good deflation is what I described before. Those learning curves causing cost declines, which are passed through to prices, which will cause booms, absolute booms in these technologies and in productivity. And the virtuous cycle that we're going to see is going to be astounding. Now, many of you know that CNBC has called me Crazy Cathie. And You may think that now too, but we really believe what I just said because we're doing the research. We're doing the research that very few people out there are doing because they just don't believe it. They don't believe it. And they also don't believe you should do much from the top down. And that became a kind of the mantra as I was growing up in the business. In the old days, most portfolio managers had macroeconomic backgrounds, and they did think top down. Then we went into this bottom-up world. You can't think top down. That'll get you thinking crazy thoughts like this. And that's why there is the psychology out there. I believe that truth will win out. And, you know, we got our first taste of this. We've gotten two big tastes of it. And JD, Steve's son, is in the audience, I believe. And during the pandemic, a lot of young people were stuck at home, and they discovered the stock market, and they discovered ARK, actually, that way. And we were talking a lot about Bitcoin and Tesla and innovation generally, but those two really resonated with the young people. And we couldn't, and they ended up performing spectacularly because this concept of, in the case of Tesla, super-exponential growth is starting to play out, especially now that other auto manufacturers are pulling out, and because of all of the advances in AI that are going to take it into the autonomous world. And in the case of blockchain technology, and this is where I'll end, I met George through my teacher, professor at USC, and mentor, and now dear friend, Art Laffer. And Art is 83 years old. And in 2015, we asked Art if he would co-author or just collaborate with us on a paper having to do with this thing called Bitcoin. And he reserved judgment until he read the paper. He read the paper, he was quite intrigued by it, and he tore it apart, as I expected him to do, and said he would put his name to this and not to that, not to the technology part, but to the economics part. And we really do believe that Bitcoin is, and each one of these words is important. It is the first global, private, no government oversight, rules-based, critical, rules-based, digital monetary system ever. And it's a very big idea. We think that the entire crypto asset ecosystem, and we think most of the crypto assets you have heard about out there, will disappear. There will only be a few for different reasons. That ecosystem in 2030, we think, will be a $25 trillion ecosystem. Right now, it's a little over $1 trillion. We think that the biggest idea out there is Bitcoin. And so I'm going to end. In the public and private equity markets today, we believe, according to our estimates, truly disruptive innovation is valued globally at, after the setback this year, probably $12 trillion. We believe that is going to scale to $200 trillion in the next 5 to 10 years. And one of the reasons is the reason is the 5 innovation platforms evolving and converging and creating super exponential growth in those technologies, but also in the real economy.